In our report this quarter, we will review the global markets, CLS portfolio performance, and our market outlook, and how that is impacting portfolio positioning moving forward. This includes our latest thinking on the CLS investment themes, including what is working and what is not working for CLS portfolios so far this year. Welcome to the CLS Market Outlook for the third quarter of 2017. I'm Ryan Beach. It was another good quarter for the global markets. Nearly all major asset classes posted above average quarterly returns. To begin, our Chief Investment Officer, Rusty Vanneman, explained specifically what was and what wasn't working in the markets.
Well, thanks again, Ryan. I'd like to talk about three things. First, I would like to review the markets. Second, our outlook. And third, the investment themes at CLS and how they've impacted performance. First, market review. It was another great quarter for the global markets. The U.S. market was up. International markets were even more. The bond market even had an above-average return. It's been a great quarter, a great year. It's been a great last 12 months, and you can keep stretching it out. About the only asset class that has not been performing well has been commodities, and we'll talk a bit more about that later. When it comes to our outlook, it basically is the same as it was last quarter. Because the U.S. market has had a great bull market, valuations tend to be above average. That means expected returns are below average moving forward. International markets are different. Even though they've been outperforming of late, their valuations are still a lot more attractive, and in many cases, they are expected to have above average returns. Fixed income, interest rates are still low, but we think that as investors, you have to be active to be able to enhance returns. And then we are also looking at alternatives and commodities in terms of adding performance over time as well. When it comes to our three investment themes, the first one is global value. There's something part of that theme that has helped tremendously, and that has been our exposure to emerging markets, which has been our most significant portfolio tilt recently and in recent years, and that has really helped performance. However, on the other side is that we've been emphasizing value stocks. Again, over the last 8 or 9 years, we've mostly been emphasizing growth stocks, but we moved to value stocks last year just in time to catch the best quarter, or one of the best quarters for value investing in the fourth quarter of last year. This year, however, a lot of that performance has been given back, at least in relative terms. Value stocks are still up. That ties into our second theme, which is smart beta ETFs. We're one of the leading users of smart beta ETFs. We will continue to do that. Again, smart beta ETFs are those ETFs that capture the essence of active management. There are many kinds of smart beta ETFs, but one kind that we like are value-oriented, and those, of course, have not really worked this past quarter. Other smart beta ETFs, on balance, have helped. The last theme is creative diversification. Again, this ties into interest rates are low, but we still like fixed income. We think that you just need to be active in your fixed income allocations. And on the fixed income side, our selections this year have been adding value. That's great. But the other part of the creative diversification theme that has not worked is the fact that we've been using alternatives, including commodities. Our commodity exposure has not been large, but given the underperformance of that asset class, that has weighed on performance a bit this year. We'll talk more about commodities later on in the quarterly market outlook as well.
Let's examine in a bit more detail the three key portfolio tilts that impacted CLS portfolio performance last quarter and so far this year, and what we're thinking about them moving forward. First, let's look at a key portfolio tilt related to our global value theme, emerging markets. To discuss this, let's listen in to CLS portfolio managers Paula Wick and Kostya Edis.
So Kostya, you, our analyst Jessica Golson, and we've all been meeting on the international research team at CLS. And it has been really exciting to see the rebound international markets this year.
Absolutely.
I mean, this quarter, we've had emerging and developed kind of go neck and neck, but they've far outpaced domestic markets. And then year to date, emerging markets have been about double the performance of domestic markets.
Emerging markets have truly been on fire. It's been staggering to see. And particularly, one area that we really like, emerging markets Asia, including countries like China and India, has done really particularly well this year.
And as many of our clients know, we do have significant allocations to international markets, and then, as you said, emerging Asia. It's very significant.
Absolutely. How about we transition a little bit and do some trivia?
Uh-oh, okay.
All right, what % of the world population is within emerging markets?
I do know that, 85%.
Crushed it.
Okay. All right, I've got one for you.
All right.
All right. So what percentage of global GDP is made up of emerging markets?
Easy. That's 50%. But what's really interesting is that no more than 20 years ago, it was only 20%.
I know it's been growing tremendously. And the one thing that's really interesting, though, is that in global stock indexes, you still see emerging markets only being 10% of that allocation. And then what's even more staggering to see is that most investors only have like a 3.5% allocation. So they're really underexposed to emerging markets.
That is unfortunate to hear. And the key thing to think about here is economic growth. Within
Right.
emerging markets, it's more than 2 times that of developed markets. And that growth is expected to continue going forward because emerging markets simply have better demographics. What I mean by that is they have younger populations, and that should lead to more labor productivity.
And then speaking of their populations, I know that another big driver is going to be the emerging market consumer. They're anticipating major growth there. I know the McKinsey & Company just recently said that they expect that it's going to be one of the biggest growth opportunities in the history of capitalism.
Wow.
Yeah.
Those are some bold words, but I believe it. I mean, all the data we've presented points that way. And, one thing to think about also, even though emerging markets have had such a great run this year, their relative valuations are still very attractive. And now they've got momentum on their side as well as earnings growth.
Yeah, definitely. Emerging markets seem to be the place to be right now, and then most likely in the years ahead for investors.
Turning now to our smart beta theme, one area of portfolio emphasis that helped performance last year that hasn't so far this year is our exposure to smart beta value ETFs. While they have performed well in absolute terms, they have trailed more high-flying securities in relative terms. To discuss this topic in more detail, Rusty sat down with CLS research analyst Mark Matthews.
Well, thanks again, Ryan. And Mark, welcome to the Quarterly Market Outlook.
Thanks, Rusty. Thanks for having me.
Yeah, you do so much work for us, particularly on individual equity analysis. And I wanted to bring you in this quarter because, as you know, one of our biggest sort of underweights in the portfolios are these something called the FANG stocks.
Okay.
What are these FANG stocks?
Well, FANG stocks, again, FANG is a name coined by the media, but Facebook, Amazon, Netflix, and the Google parent Alphabet.
Yeah.
But most recently, it's been added to by many of the media and added to with Apple and Microsoft FanMag.
Yeah. Yep. And those two names include, that would be Apple
and
Microsoft. Yeah. Why is this important for us to know?
Well, it's important for us to know because for the primary reason is those 6 stocks have anchored performance year to date. I think 4 of the 6 are up more than 20%, and year to date, I think they account for about 27% of the overall market performance. So them really having that influence on overall market performance has really been why the emphasis has been placed on those.
Now, those names, since they've been the performance has been so concentrated in those names, it's kind of like the late 90s in terms of just a handful of names driving stock market performance so strongly. Like, you remember the late 90s?
Yep.
Yeah, of course.
Yep. Probably a child at that time, but I remember it.
Exactly. So how is CLS positioned in these names?
Well, as you know, CLS, we're relative value investors, so we are effectively underweight those names. Again, and that due primarily to those rich valuations. So again, relative value investors, we're underweight.
Yeah. And what is our outlook on these stocks moving forward?
Well, I'm glad you asked that, Rusty.
Yeah.
Our outlook is negative. And as a fundamental guy, I can name a laundry list of things as to why we're
I know
underweight.
you can. Just go with a couple instead.
I'm going to leave you guys with two.
Okay.
I'm going to leave you guys with two. The primary is relative valuations, as I mentioned earlier.
Yeah.
Those stocks are effectively trading at 2 times the multiple of the global market. And secondly, the primary fundamental drivers of market performance for those particular stocks has plateaued. So given those two constraints, we just don't see it optimistic to.
So you're talking about the fundamental characteristics like earnings growth and profitability.
Profitability, free cash flow, things of that nature have plateaued. So taking those things into consideration, the benefit from holding those stocks just isn't there anymore.
Great. Well, Mark, thank you very much.
Thank you.
We'll have you back. All right. Thanks.
Next, let's go back to Rusty and discuss our creative diversification theme a bit more, including our view on the commodity asset class.
Thanks again, Ryan. Okay, let's talk about commodities. We've talked about how that has negatively impacted performance so far this year. So what are we thinking about it moving forward? In short, we like it, and I think investors should expect that we'll probably see more exposure to this asset class moving forward in the months and quarters ahead. And here's why. First of all, commodity prices are down considerably this year, led by a variety of commodities, including the energy prices. But one thing is that some commodity indexes have broken down to multi-year lows. In some cases, we've seen all-time lows on an inflation-adjusted basis. So commodities are on sale. Another thing to think about when it comes to the commodity asset class is that it sort of is that default option when traditional asset classes such as stocks and bonds are overvalued. Of course, in the U.S., the U.S. stock market has above average valuations and interest rates are below average, suggesting both are expensive by historical measures. That would make commodities attractive. In fact, commodities do have, by some measures, higher expected returns now in the U.S. than stocks and bonds. And of course, at CLS, as risk managers, we are always attracted to the ability of the commodity asset class to help manage portfolio risk. So on balance, we still like commodities and expect that we will be buying more in the months ahead.
That concludes our outlook for the third quarter of 2017. Our next market outlook will be this October. From all of us here, I'm Ryan Beach. Thanks for watching, and thank you very much for your time and trust in CLS Investments.